Gold $500 crash. Lie exposed. Real data. They're hiding from you. On January 30th, 2026, someone told you gold recovered to 5,181. Someone told you the trap failed. Someone told you. Manipulators lost. 3 hours later, gold collapsed to $4,941. Silver crashed 17% in a single day. The biggest precious metals bloodbath since 2013. And that recovery they promised you? It never happened. But here's what they really don't want you to know. Welcome back to XAU and XAG. Now, before we go any further, if you've been with us for a while, you already know what we do here. But if you're new, I have a small request. The way you once told your children to always verify before they trust, I'm asking you the same thing today. Subscribe, not for me, but for yourself. So the next time someone sells you a lie, you'll have the facts first. Now tell me in the comments, where are you watching from today? Pakistan, India, UAE, America, UK? Let me know, because this story concerns all of us. Now, let's begin. It was Thursday morning, January 29th, 2026. A content creator sat in front of his camera. He looked excited, almost triumphant. Gold had just bounced from $5,100 to $5,281. Silver had climbed back to $115. He pressed record, and he told his audience the words they wanted to hear. The trap failed. Manipulators lost. V-shaped recovery is complete. If you held, you are a legend. His viewers watched. They believed. They held their positions. Some even bought more. Because a man on the internet told them the worst was over. But 3 hours later, something happened. Something he didn't tell them about. Something he couldn't have predicted, or could he? Gold began falling again. Not slowly, not gradually. It collapsed from 5,381. It dropped to 5,064. Then it crashed further to 4,941. In just one trading session, an 8% decline. In a single day? And silver? Silver was worse. Much worse. From $121.64 on Thursday, it plunged to $95 on Friday. A 17% crash in 24 hours. The biggest single-day decline in 13 years. According to Fortune magazine, gold closed at $5,064 on January 30th, 2026. Not 5,381, as the creator had claimed. Silver closed at 99.904. Not 115s, as his audience was told. Finance Magnates reported it clearly. The strongest XAU and XAG sell-off in 13 years. Gold crashed 8% to $4,141. Silver plunged 17% to $95. These were not opinions. These were facts, published by verified financial sources, available to anyone who cared to look. But here's the real question. The question that matters: how many people looked? The content creator's video had thousands of views. His comment section was filled with celebration. Diamond hands. I held. We beat the manipulators. But the market did not care about comments. The market did not read his script. The market simply followed supply and demand. There is a dangerous gap in today's financial world, a gap between financial entertainment and financial reality. On one side, there are creators. They make videos, they build narratives, they create excitement. Their goal is engagement, likes, shares, subscribers, comments. This is how they earn. This is how they grow. On the other side, there is the market. Cold, indifferent, mathematical. It does not care about narratives. It does not reward loyalty. It simply moves based on data. And when these two worlds collide, when entertainment meets reality, someone always pays the price. That someone is usually the retail investor, the man who watched a video after a long day of work, the woman who trusted a confident voice on her phone screen, the young entrepreneur who thought he found an edge. They believed the recovery was real. They believed the bottom was in. They believed because someone told them to believe. Trading Economics, one of the most respected data sources in the world, published their analysis on January 30th. Gold slid more than 7% on profit-taking, but remains on track for a monthly gain of over 15%. Its strongest performance since the 1980s. This single paragraph told the complete story. Yes, gold had a strong month. Yes, gold was still up 17% in January, but it was also crashing because of profit-taking, normal, predictable, profit taking? The creator never mentioned this. He spoke of manipulation. He spoke of conspiracies. He spoke of banks and market makers and shadowy forces. But he never mentioned the simplest explanation. When something rises 24% in 1 month, people sell, they take profits, they book gains. This is not manipulation. This is market mechanics. But the question remains, why did he choose conspiracy over simplicity? Why did he create enemies instead of explaining economics? And most importantly, what else did he hide? The answer lies ahead. There's a word, a powerful word, a word that makes ordinary people feel important. That word is manipulation. When a man loses money in the market, he has two choices. He can say, I made a mistake. Or he can say, someone cheated me. The first option is painful. The second option is comfortable. And comfort sells very well on the internet. Pause. The content creator knew this well. He stood before his camera and he gave his audience exactly what they needed to hear. This was coordinated manipulation. Banks deliberately crashed the price. Market makers pulled their bids. They wanted to flush you out. His audience nodded. They felt validated. They felt like victims of a great crime. Not investors who bought at the wrong time. Documentary shift. But here's what actually happened. According to verified sources, according to data that anyone can access, the first truth, profit-taking gold had risen 24% in January alone. Silver had climbed 64% since the start of 2026. These were extraordinary gains, unsustainable gains. When any asset rises this fast, large investors sell, institutions book profits, hedge funds rebalance portfolios. This is not conspiracy. This is Tuesday. This is what markets do. Trading economics documented it clearly. Gold slid more than 7% on profit-taking. Not manipulation, profit-taking. The most normal event in any financial market. Pause. The second truth, CME margin hikes. On January 29th, the CME Group, the world's largest derivatives exchange, made an announcement. They raised margin requirements on gold and silver futures. Now, why would they do this? The content creator had an answer. They want to shake you out. They want to steal your position. But the actual reason was far less dramatic. According to finance magnates, CME raised margins because they feared a systemic collapse of the futures market due to runaway volatility. In simple words, the exchange saw danger. Prices were moving too fast. Too many speculators were using too much leverage. The system was becoming unstable. So they did what exchanges always do. They raised margins to slow down speculation, to prevent a larger disaster. Historical context. This was not new. This was not unusual. This has happened many times before. In 1980, gold reached $850 per ounce. Then it crashed more than 60%. The trigger? Margin hikes. In 2011, silver touched $50 per ounce. Then came what traders call the Sunday night massacre. Silver collapsed in hours. The trigger? Margin hikes. The pattern is always the same. Prices rise too fast. Exchanges raise margins. Leveraged traders are forced to sell. Prices collapse. This is not manipulation. This is market regulation. This is how exchanges protect the system. Pause. The third truth, Federal Reserve uncertainty. On the same week, President Trump made an announcement. He nominated Kevin Warsh as the new Federal Reserve Chair. Now, the content creator mentioned this, but he got the name wrong. He said Rick Reeder from BlackRock would become Fed Chair. He said the new chair would be explicitly dovish. Both statements were incorrect. But according to NPR, Trump picks Kevin Warsh to lead the Federal Reserve. Warsh has frequently warned of inflation. He was on the hawkish side during his previous term. Hawkish means higher interest rates. Higher interest rates are bad for gold and silver because gold and silver pay no interest. When rates rise, investors move to bonds, to bank deposits. They leave precious metals. The creator told his audience the new Fed chair would be dovish. The creator told his audience this was bullish for gold. The creator was wrong. Reflective pause. 3 factors: profit-taking, margin hikes, Fed uncertainty. All documented, all verified, all public information. Together, they explained the crash completely. No conspiracy was needed. No shadowy bankers were required. No manipulation theory was necessary. Direct address. But manipulation makes a better story. Manipulation gets more clicks. Manipulation keeps the audience angry, engaged, subscribed. And that is the real game. Not gold, not silver. Attention. The creator was not selling precious metals. He was selling a narrative. And his audience bought it with their trust, transition but wrong predictions, and conspiracy theories. These were not his only mistakes. There was more, much more, that he kept hidden. Information that could have saved his viewers thousands of dollars. What was it? Part 3 will reveal everything. A man named Nathan Rothschild stood in London, waiting across the English Channel. A war was ending, the Battle of Waterloo, Napoleon versus Wellington. The outcome would determine the fate of Europe. But Nathan Rothschild knew the result before anyone else. He had his own messengers, his own ships, his own information network. While others waited for newspapers, he acted and he bought when others were selling. And he made a fortune. Pause. This is called information asymmetry, when one person knows what another does not, when one person sees what another cannot. It was powerful in 1815. It is powerful in 2026. Shift to present. The content creator had information, lots of information, charts, data, analyst reports, bank warnings, but he made a choice, a deliberate choice. He decided what to show and what to hide. Investigative tone. Let us examine what he hid. Hidden warning. Number 1, Bank of America. In the last week of January 2026, Bank of America, one of the largest financial institutions in the world, published a research note. It said something important, something his audience needed to hear. Silver is one of the most overheated assets in the world. Prices are 30% above long-run fundamental averages, 30% above fair value. This is not a small number. This is not a minor concern. This is a warning sign, flashing red. Did the creator mention this? No. He talked about manipulation instead. Pause. Hidden warning. Number 2, the gold-silver ratio. There is a number that experienced traders watch closely. It is called the gold-silver ratio. It tells you how many ounces of silver equal 1 ounce of gold. Historically, this ratio stays between 60 and 80. Sometimes higher, sometimes lower. But it has a range, a normal range. In January 2026, the ratio fell to 45, the lowest in 14 years. What does this mean? It means silver was rising much faster than gold. It means silver was running ahead of itself. It means silver was in dangerous territory. Sunday Guardian Live reported this clearly. The ratio indicates silver might be racing faster than sustainable value models. Did the creator share this warning? No. He told his audience silver would hit $150. Pause. Hidden warning. Number 3, technical indicators. Professional traders use tools, mathematical tools, that measure momentum. One such tooling is called RSI, Relative Strength Index. When RSI goes above 70, an asset is considered overbought. When RSI goes above 80, traders become cautious. When RSI goes above 90, experienced investors start selling. In late January 2026, gold's RSI crossed 90, silver's RSI was even higher. Every technical analyst saw the same signal. Extreme overbought conditions, high probability of correction, reduced exposure. These signals were public. These signals were free. Anyone could see them. But the creator chose not to show them. Instead, he showed excitement. Instead, he showed celebration. Instead, he created a trap. Documentary tone, hidden warning. Number 4, historical parallels. Finance Magnates published an important comparison. This reversal draws parallels to the 1980 gold crash and the 2011 Silver Sunday Night Massacre. In 1980, gold crashed over 60% after its peak. In 2011, silver fell from $50 to $26 in weeks, both times. The pattern was the same: rapid rise, extreme optimism, then collapse. The creator knew this history. Any researcher would find it in minutes, but he chose not to mention it. Why? Reflective pause. Because fear does not get subscribers. Because caution does not go viral. Because warnings do not build audiences. What builds audiences is hope. What builds audiences is excitement. What builds audiences is the promise of easy money. Serious tone. This is the information asymmetry of our age, not between banks and retail investors, but between content creators and their audiences. The creator sees all the data. He chooses what to show. The audience sees only what he allows. And when the audience loses money, the creator loses nothing. He still has his subscribers. He still has his views. He still has his next video. Pause. Business Today summarized it perfectly. Analysts expect gold and silver to remain volatile. Short-term corrections do not negate longer-term drivers, but investors must understand both sides of the story. Both sides. Not just the bullish side, not just the exciting side. Both sides. Transition. The creator showed one side, he hid the other, and his audience paid the price. But now, the question becomes, what should an investor actually do? How does one separate truth from narrative? How does one protect wealth from entertainment? The answer requires a framework, a strategic framework for the serious investor. And that is exactly what Part 4 will deliver. There was once a merchant in ancient Persia who sold carpets in the Grand Bazaar. One day, a young man came to him, eager, excited, ready to invest his inheritance. "Tell me," the young man said, "which carpet will make me rich?" The old merchant smiled. He did not answer the question. Instead, he asked one of his own, "Do you know how to tell silk from cotton?" The young man did not know. "Then it does not matter which carpet you buy," the merchant said quietly, "because you will always be fooled." Pause. This story is not about carpets. It is about knowledge. It is about the ability to see what others hide. Transition to framework. The gold and silver market is filled with voices. Some speak truth. Some speak lies. Most speak a mixture of both. Here is how. When watching any financial content, a serious investor must look for warning signs, red flags that reveal the creator's true intentions. Red flag. Number 1, emotional language. You are a legend. Diamond hands. We showed them these words are not analysis. These words are manipulation. They make the viewer feel special. They make the viewer feel part of a tribe. But markets do not care about tribes. Markets reward discipline, not emotion. Red flag number 2, enemy creation. The manipulators fear you. Banks are trying to steal your wealth. They want to shake you out. When a creator builds an enemy, he is not educating. He is recruiting. He is turning investors into soldiers. Soldiers who will hold positions even when they should sell. Red flag. Number 3, artificial urgency. Monday could be the biggest gap up in history. This is your last chance. If you don't act now, this is not information. This is pressure. This is FOMO. Fear of missing out, weaponized. Red flag number 4, engagement farming. Type "I held" in the comments. Subscribe right now. Like this video if you're a true believer. The goal here is not education. The goal is algorithm manipulation. The creator wants engagement, not enlightenment. Now, here is what a serious investor must understand. Gold and silver are not bad investments. They are not scams. They are not traps. With real value, the bullish case, what is true? Central banks are buying gold aggressively. JP Morgan reports 585 tons of quarterly demand. This is real. This is verified. This matters. The US dollar is weakening. The dollar index, DXY, fell to 96.7 in January. A weak dollar supports gold prices. Section 3, practical guidelines. For those already invested, emotional decisions lead to permanent losses. Check your position size. Is more than 10% of your wealth in metals? If yes, you are overexposed. Diversification is not optional. It is survival. Know your exit point before you enter. Hope is not a strategy. Gold, $5,000. Psychological support. Gold dinked 4,550 to 4,360. Major technical support. Silver, $95 to $100. The current battleground. Closing reflection. Finance magnates wrote something important. The fundamental bull case for metals remains strong. But the path upward is rarely a straight line. This is the truth. Not exciting, not dramatic, but true. Final message. The market does not care about YouTube videos. The market does not care about narratives. The market does not care about manipulation theories. The market cares about supply. The market cares about demand. The market cares about human psychology. The creator who misled his audience, he will make another video tomorrow. He will have new predictions. He will have new excitement. But his audience, the ones who believed, the ones who held when they should have questioned, they will carry the losses. Pause. Do not be that audience. Be the merchant who knows silk from cotton. Be the investor who sees both sides. Be the person who verifies before trusting. This is not about gold. This is not about silver. This is about protecting what you have built. Stay informed. Stay rational. Stay safe. End of part 4. Word count 700 closing and call to action. Warm tone. And that is the complete story. The story they didn't want you to hear. If this video helped you, if it saved you from a mistake, or simply made you think differently, then do one thing for me. Share it with a friend, a brother, a colleague, someone who might need these facts. And if you haven't already, join the AU and AG family. Subscribe and turn on notifications. So the next time someone tries to mislead you, you will have the truth. First, tell me in the comments, what did you learn today? Did you make a decision based on that other video? I want to hear from you. Until next time, this is AU and AG, where we separate facts from fiction and truth from narrative.